As you might guess, many businesses sell more than one product. When you sell more than one product, we learn a new concept called sales mix, and this is a concept you're probably already familiar with. Basically, it's just a percentage of each product that you sell when you have more than one product. So for example, if you have a restaurant and you sell sandwiches and pizza slices, if you sell 300 sandwiches and 700 slices, that's a total of 1,000 units you sell. Well, the percentage is just a breakdown of the two, so 300 over 1,000 gives you 30% sandwiches and 70% slices. So that's your sales mix, 30%, 70%. And that's all it is, and you can have as many products as you want, and you just have a percentage for each one. It should add up to 100% to cover all your sales. Margie has decided that in addition to selling t-shirts, she wants to sell custom silkscreen flags. She heard it's a thing now, and she wanted to get in on that. So she figures her sales mix is going to be 70% shirts and 30% flags. Let's look at a quick income statement. So if she sells the shirts at $35 a piece, and then she has determined that her variable costs are going to be back at $21, she has a contribution margin of $14. So every shirt she sells, she has $14 left over to contribute to the fixed cost. The flags she can sell for $70. The variable costs are going to be higher. They're a lot larger. And so that's going to be $40 each flag for a contribution margin of $30. Margie wants to figure out her break-even point when she adds this new product to the mix. As you recall, the break-even point is the fixed cost divided by the contribution margin. However, we have two contribution margins, $14 and $30. So which one do you use? And the answer is that you want to take kind of an average of the two, but you want to do a weighted average of the two. So when you do a sales mix, you're going to do the fixed cost divided by the weighted average contribution margin. How do we get that weighted average contribution margin? So we want to take the contribution margin times the sales mix. So we'll do that contribution margin of the sales mix for each product that's sold. We have the flags and we have the shirts. The sales mix is a 70-30 mix. The contribution margin we just pull from the table above, $14 and $30, and then you multiply the two together, and that gives you the weighted average contribution margin for each one, and you just add them up. So in this case, the weighted average contribution margin is going to be $18.80. Now when we apply that weighted average contribution margin to the break-even formula, we see that we need 372.34 shirts and flags together in order to break even. So we can't sell 0.34 of an item. Break-even points always round up. So if we want to know how much of those 373 units need to be shirts, we just multiply by the sales mix, 70%. So that means we need to sell 262 shirts, again we round it up, and 112 flags. Another useful tool for doing analysis is called the margin of safety. And the margin of safety is a fairly simple formula. It's just taking the actual sales, in other words, what you really sell, to the customers, and subtracting from it the break-even point. And that gives you your safety net. It's your margin of safety, meaning how far away, how much bigger are your actual sales than your break-even point needs to be in order to cover your costs. So that tells you kind of how much you can drop in sales before you have to worry about starting to go into a loss situation. So in this case, we know that our actual sales are 950 shirts. We're going to ignore the sales mix right now. We're just going to look at one product while we learn this new concept. So 950 shirts, and then we learned the break-even point was 500. So 950 shirts minus the break-even point of 500 shirts means you have a margin of safety of 450 shirts. You can lose sales in the amount of 450 shirts before you get to the point where you're at break even, and if you lose any more, you lose money. So the margin of safety gives us the safety net that we have. Now a lot of times managers want to see this in terms of dollar amounts, how far their dollar sales can drop. Since each shirt sold for $35, then we just multiply the 950 shirts times 35 and the 500 shirts times 35, and we can figure out the dollar amount that we can lose. A ratio can help us to make comparisons because it puts things into percentages. So the margin of safety ratio is just taking the margin of safety and making a ratio out of it. So the margin of safety divided by the sales is going to be your margin of safety ratio formula. So the margin of safety that we learned above was 450 shirts divided by 950 shirts was our sales. So we get 47.4%. And so this is just telling us that instead of looking at the number of shirts we can drop as a margin of safety to get to the break even, it just says the percentage of sales. So we can drop 47%, actually a little bit over 47%, before we have to worry about losing money. When we put the dollar amounts in, $15,750 as the margin of safety and $33,250 as the actual sales, we get the same percentage. So you can do it either way, just depending on the situation you find yourself in. Now, another term that we can use for doing analysis on a business is called the degree of operating leverage. The degree of operating leverage says how much the operating income will change when the sales increase or decrease. So if there's a change in sales, how much of that will hit the bottom line? The formula for the degree of operating leverage is just to take the contribution margin divided by the operating income. So let's go back and look at Margie's custom silkscreen and its original contribution margin income statement that we started with. So we're at 950 units. That's the actual sales that she has, and then we have the variable cost of $21 each, and we get an operating income of $6,300. So we can use this to determine the degree of operating leverage. We'll just take the contribution margin of $13,300 divided by the operating income of $6,300. When we do this, we get a degree of operating leverage of 2.11. So what that means is that for every dollar in sales that changes, goes up or goes down, the operating income, the profit at the bottom, is going to change by twice that much, by $2.11. So if my sales change by 1%, then the operating income will increase by more than twice that, 2.11%. If my sales were to go up by 10%, my operating income would go up by 21%. So a $1 change in sales means more than a $2 change in operating income. Now, this is a good thing to have a high degree of operating leverage if you're increasing your sales. However, it goes the other way too. In other words, if your sales drop, then the profit goes down faster. So if you lose $1 in sales, you'll lose $2 in profit. So it really depends on the situation as to whether or not operating leverage is going to work for you or against you. But it's important for managers to understand their operating leverage so they can understand the risk from changes that they might make in their business.